Today I'm speaking to Sue Torr at Crew Invest, Managing Director, about what happens to your investments when you die. Sue, something we've noticed when we do client investments is that they actually don't know how it's wound up in the event of them passing away.
That's correct. So if you are going to build wealth for future generations, it's really important to understand how those investments will be dealt with when you die. And it really does depend on the type of investment that you're dealing with. So Cherise and I are really going to talk about the different types of investments and how you can ensure that they devolve on the people that you intend that wealth to be transferred to. At the outset, we're going to talk about retirement funds, which include pension funds, provident funds, preservation funds, and retirement annuities, and how the death benefits from those investments are distributed in terms of Section 37C of the Pension Funds Act.
Section 37C of the Pension Funds Act actually directs the trustees of a fund to investigate who a member's beneficiaries need to be in terms of financial dependency. Financial dependents can be anyone from your children, a spouse, siblings, or aged parents that you've been supporting at the date of your death. The benefit then gets paid directly to the beneficiaries that's been investigated by the trustees, and therefore there's no executive fees or estate duty charged on these funds. The last point I would like to mention is that these funds are protected from creditors, but it doesn't include tax payable to SARS or maintenance claims.
So the point here to remember is that retirement funds fall outside of your estate and are not dealt with in your will. They are in fact distributed by the trustees of the retirement fund according to who is financially dependent, either wholly or in part, at the time of your death. On the other hand, living annuities and life annuities do not fall within the auspices of the Pension Funds Act, and these are dealt with differently in the event of death.
So the fundamental difference between pre- and post-retirement investments is that they are regulated by two different pieces of legislation, where post-retirement investments are legislated by the Long-Term Insurance Act. So the two types of annuities that you get is a life annuity and a living annuity. A life annuity should not be included in your estate planning, as income is only paid to you while you are alive. At the point when you die, that income stops.
On the other hand, a living annuity is not a life policy. It's actually an investment held in the name of the individual investor. And as such, it can actually make a really good estate planning tool if structured correctly. The beauty of a living annuity is that the capital can be left to your beneficiaries in the event of your death. And this is achieved by nominating those beneficiaries on your living annuity policy. In the event of your death, the proceeds of your living annuity, being the remaining residual capital that you have not yet spent in your retirement years, is then paid directly to your beneficiaries, although they will need to direct the fund as to how they wish to receive that capital. So for instance, they could wish to receive the capital in cash, or they could want to transfer that capital into a living annuity held in their own name, or they could take a combination of both, keeping in mind that the first 550,000 Rand of that withdrawal, any cash withdrawal that they make, will be tax-free, depending on the retirement withdrawal history of the deceased.
That's correct, Sue. And it's also important to note that the proceeds of the living annuity funds will not be included in the deceased estate. Therefore, no estate duty or executor's fees are attracted. From the beneficiary's side, when you transfer the funds to a living annuity in your own name, there will be no taxes when you transfer the investment, but the income received from those investments will fall into your personal income tax rate, and therefore it will be taxed at that point.
So all in all, living annuities can make excellent estate planning tools if they have been set up correctly and your beneficiary nomination is appropriate to your estate planning goals. So let's move on to discretionary investments. They are more flexible and accessible during your lifetime, not so much in the event of your death. So, for example, let's look at an endowment, which is an investment that is more suitable for those with a marginal tax rate of 30% or more. And they can also make really good estate planning tools in that you can nominate the life assured and you can nominate the beneficiaries to that policy.
When the last life assured dies, the proceeds will be paid to the beneficiaries immediately after death. From an estate planning point of view, it will be seen as deemed property in your estate and therefore attract estate duty. At the winding up though, the executor does not take care of the administration and therefore there is no executor's fees on this type of policy.
So another type of investment that we need to talk about is tax-free investments. And the way that these investments are dealt with in the event of your death really depends whether they are housed on a LISP platform or in a life wrapper.
So when it's on a LISP platform, it's very much a standard unit trust and therefore it will be dealt with in your will and you will pay executors' fees on it and there will be estate duty on it. If it's in a life-wrapped investment, that means the executor doesn't deal with it and the proceeds get paid to the beneficiary straight away. But because it's seen as deemed property, there will still be estate duty applicable to the investment.
So finally, let's get to unit trusts or collective investment schemes.
So once again, with a unit trust, it is a standard unit trust on a LISP platform and you cannot nominate beneficiaries on this. This will be dealt with in your will. It will get wound up and once the estate is completely wound up, that will dissolve on your beneficiaries as per the will.
Also keep in mind that if you have offshore investments that are housed in a rand-denominated fund, so indirectly invested offshore, these can add a layer of complexity to your estate planning. Bearing in mind that if you are indirectly invested offshore, those assets will be able to be dealt with by your South African will.
So with a foreign domiciled fund, your South African will can deal with it, but in certain instances, the foreign jurisdiction might have specific rules and regulations around it, and therefore you should get advice regarding that jurisdiction in order to ensure that it is distributed according to your wishes.
That's correct. So remember that every country has its own laws of succession. So if you are going to invest directly offshore or hold assets offshore, it's important to understand the implications of that foreign jurisdiction on those investments.
Sue, I think we can agree that we've spoken about a lot and it can be very daunting and confusing when setting this up and to ensure that your intentions line up with the investments you choose.
If you have taken the effort during your lifetime to generate wealth and you intend to transfer that wealth to the next generations or subsequent generations, it's really important to understand what vehicles your wealth is being housed in and the applicable legislation when it comes to actually transferring that wealth. So as you can see in the table that we have in front of you, we've tabulated the different type of investment vehicles that are available and how those assets will devolve on your heirs and beneficiaries in the event of your death, and some comments that you might want to consider when structuring your overall investment portfolio.